Alan Kohler here, and I'm talking now to Chad Padowitz, who is the Chief Investment Officer of Talaria Asset Management, which used to be called Wingate. Got about 500 million under management, and it's got some very interesting investment methods. It's a global investor, value investor, but they generate quite a lot of income, tending to be 7% plus income, not franked, of course, because it's all global, but 7% plus income based on the way they use the options and derivatives markets to buy their shares. So it's quite interesting, well worth having a listen to this or a read of the transcript. So here's Chad Padowitz, Chief Investment Officer and founder of Talaria Asset Management. Well, Chad, Talaria Asset Management used to be called Wingate. Was that a management buyout, and when did it happen?
Yeah, yes, it was. The business has been going for 15 years, Wingate Asset Management. In about 18 months ago, we did a management buyout and changed the name to Talaria. It's the same business, the same underlying clients and employees. We merely changed the ownership structure to better represent, to more align the business with its clients.
Right, and so it's now owned by the staff. Is that right?
Yeah, there's three principals, of which I'm one, and I've got two partners, Hugh Selby-Smith and Jamie Mead, which we own the majority stake in the business, with Wingate maintaining a minority stake.
Right, okay. And how much do you have under management?
We're a little over 500 million.
Right.
And we've grown. We only run the one fund, so we only have effectively one product. We think because it's the best way to manage money, so we only do one thing. And that's grown, it's basically doubled in the last 2.5 years.
So are you saying that your performance improved after the management buyout?
The commercial, improvement, yes, we invested into distribution, branding, basically client engagement, and that's obviously had a significant impact in our investment flows.
And what about your performance?
Yeah, well, our performance, we've got a 15-year track record, and that's been very good, and it's met the objectives that we've had. And I can talk to those, and that's been maintained, since inception, and certainly in the most recent since the MBO as well.
So what are your objectives? Because I note that you seem to emphasise income. So is it an income fund?
No, okay. So our objective is to compound real wealth over time, and that is so that it basically over rolling 3-year periods to have more money over time. Now, we certainly expect to beat other asset classes and comparative market returns over a full market cycle, but we are not benchmark aware in the more shorter term. We see income as an important component of return, so we do not focus on generating income. We do generate it as part of the process, but we see income as an important component of return. We've obviously, our process allows us to generate a very high amount of income, which disproportionately in the current environment is very attractive.
Why is that? What about your process that generates income?
Yeah, the manner in which we buy shares, so we are a long-only global equity fund. The manner in which we buy shares, we sell put options, cashback put options as a means of entering into positions we want to own for the long term. That generates a premium. That premium is impacted by market volatility, such that higher volatility leads to higher income. So that income, which historically has been around 7% a year as a component of return, we've generated about 7% in income. Currently, that's running closer to 10% a year because volatility is very elevated.
So explain to us what you mean by a cashback put option. What does that entail?
For sure. So as I said, we are a long-only bottom-up fundamental investor in equities. So assuming we want to buy a share and we think we think the share is worth $120 and is trading at $100, rather than buy the share directly, we will sell a put option at, say, $95 or 2 months out, which effectively gives the buyer of that option the right to give us the shares at $95. So we're a buyer at 95 when it's trading at 100, so that gives you a 5% buffer. But we will also get paid a premium for agreeing to buy it. And that premium would be, for instance, $2 or $3 a share. And that annualizes around 20% return. So That's the income we generate. Now, importantly, if we want to buy this share at $100, $1 million worth, we'll have $1 million in the bank. That's where the cash backed is. So there is no derivative or option or margin risk or leverage of any nature. This is just a means of buying the shares you want to buy, but getting paid for it along the way at a lower risk way.
It doesn't seem like a long-term ownership. I mean, it seems a bit less long-term than that. But perhaps
this is the means of getting the share. So once we own the share, our average holding period is about 3 years.
Right.
So this is merely a means of getting the share. So once we get the share and it drops below, say, $95 in that example, we will own it. And unless something's changed, we will own that till it goes to 120, or depending on the fundamentals of the company, or at a higher level.
So you only end up owning the share if it drops below the put option price.
That's right, because we want to always get paid for taking market risk, because every time you're a participant in the market, you're taking a risk. And it is part of our philosophy that you actually get paid for taking risk. So we think at 20 to, and currently more like 20 to 30% annualized return is a very, very high return for taking equity market risk.
Right. So that's very interesting. I haven't heard of that being done before. Is that something you invented yourself?
Well, invents are very strong word. No, the option market's been around for a long time, and it's actually becoming more and more well known, and volumes going up as well. So it's certainly the tools have been around and have just become more well known of late. But it is fair to say there haven't been too many funds that combine a bottom-up fundamental view with getting paid for taking that view. So the integration is quite unique. There will be others that do it, but not many that we're aware of. But yes, we did start the process, about 15 years ago. So effectively, it's about getting two sources of return: the shares you own, which we talked about, plus the income you get from agreeing to buy them, and that gives you that better, the better chance of earning a compounding return over time, as I talked about.
Because it seems to me that what your method involves is getting a double discount. You sort of your price estimate is below your estimate of value, but you're also buying at a discount to the current price.
Yes, and we're getting a premium for that as well. So yes, you are right. We are. There's multiple levels of lowering risk, and getting paid for that. The opportunity cost on the other side, which is obviously an obvious question, is obviously in that environment. If the share skyrockets up immediately, we don't own the share. We've just got the premium. We think over time, the combination of getting the shares you get plus the high level of return compensates for that. But yes, you are absolutely right. There's multiple levels of lowering risk.
I mean, the other thing that's notable is that your total return on virtually every time frame is almost entirely on virtually every time frame made up entirely of income, and the growth proportion is negative. So on the 3 years, growth is minus 0.308, income 8.26, total return 5.18. So, and that's kind of the same all over the place. So how come in your method you result in getting negative growth, capital growth, which is made up for by the income? Is that deliberate, or is he just buying the wrong stocks?
No, it's not buying the wrong. Look, the how that's calculated, that income side does incorporate, because the option premium actually is sometimes part of the cost base when you get exercise. So that those numbers you quote, they do conflate a couple of moving pieces together. The bottom line is the total return is what matters. And we think income as a component of total return is a very important number. But no, it's not about every share we get paid a premium on is a stock selection. So it's a bit like insurance. If you insure a bad asset, it doesn't mean, if you insure a bad asset, it's a bad investment. If you insure a bad stock, where you run an option on the wrong stock, it's a bad stock. So to earn and keep the premium is actually a source of stock selection, if that makes sense. Because if the share, I gave an example, was dropped to $60, well then that would completely more than compensate for any income generated. So I think you got to look at the total return, Income just happens to be a very big proportion, but it goes through different periods. So if you look at like 09, 010, more discrete periods, growth part was substantially higher than income because the obviously the strength of the equity market and our stock selection post the GFC. Or if you look at 2016, so there's different periods where the growth is more important than the income. But we actually look at, as an investor, a dollar in and a dollar and how much you get out is what matters, and how you break that up. We actually think is less relevant and not as important.
So, so what's your benchmark? I mean, you're not on your website. You're not actually comparing your total return to any benchmark.
Yeah, well, the investors we seek to get and to perform for, as I said, are people that are looking for a longer to achieve three broad outcomes, and these outcomes aren't really benchmark aware. And those outcomes are keeping most of the up, less of the down, generating a high level of income as a component of return, and lower volatility. Now, we do expect, and as you would expect, we do expect over time through the market cycle to outperform. And certainly since inception, we have outperformed. So I was the first dollar invested into the fund, and I am significantly ahead of the MSCI world since that time. So that is a benchmark we expect through cycle to outperform, but it is not in any way how we manage the money. And that's certainly, we think, in a market that drops 20%, we don't think minus 15 is success. So,
no, fair enough.
Yeah, so we are absolutely looking to generate a positive return in rolling 3-year periods, and substantially, in every single rolling 3-year negative performance period, we've substantially added value since inception.
Yes, maybe I'm wrong about this, but while I was talking to you, I've looked at the MSCI total return index. Last 5 years, 6.55% compound, and your return over 5 years is 3.92%. So, what am I missing there? No,
you don't. Look, as I said, through market cycle, like the last 5 years has been a very strong market that's been driven by growth and the FANGs and the Facebook, Amazons, Google. And we are a value fund. I don't think I might have mentioned that. So we are certainly in the more value end of things, which, to be fair, has been a more challenged part of the equity market. It is one we think is starting to turn. It's also been one with very low volatility. So if you look at an environment where the market's favored one sector or group over another, which it certainly has, and it's been quite extreme, as well as a very low level of volatility, which impacts our income generation or makes it a lower level, those are the sort of outcomes you would get. As I said, if you look at sort of since inception, 15 years, it is greater. But we will, in any environment where you look at, an environment where value stocks do better in a higher volatile environment, we will do much better as well. So if you look at 09 to 2011 or 12 or 13, it just depends what periods you're looking at, Alan. But
I haven't calculated the 3 years. You've said every 3-year rolling period you've outperformed the MSCI. Is that?
No, I didn't say that. No. I said every rolling 3-year period where the market was negative.
Oh, I see.
Yeah. So, one of our key objectives is not to lose money. We think that's just a very important thing. So when the market does go down, we think it's very important, obviously in the first instance, to go down less, but certainly to make money. And in environments where the market itself didn't give you what you hoped it would, we have substantially added value. Now, environments where the market's been strong, we do have an opportunity cost because we only have on average around 60% market exposure from a risk point of view, which does lead to, in very strong markets, we would likely underperform that. But as I said, that's not our objective.
What do you mean by 60% market exposure? Do you mean that you've got 40% cash all the time?
No, what that means is we have a combination of because we cash back the options, as I mentioned, we will have on any point in time, say 50% in shares we actually own. And if those shares go up or down, we would, like any other long-only fund, but then we would have, say, for instance, 30% of money in cash that's agreeing to buy shares. So we're getting paid for it by that process I told you about. But it actually is at a far lower risk, because if you agree to buy something at, say, $90 and it's trading at $100, that definitely has lower risk than if you just owned it at 100. Now, we calculate that, we use the word, delta adjusted exposure, but it's really just the mathematical calculation of what the market risk is. And when we take into account that risk plus the equities we own, it gets to around a 60% number. But importantly, about at least 80% at any point in time, minimum, is always earning a return, whether it's in shares directly or getting paid this option premium. And that gap between the 80 and the 60 is actually what drives that. Because we're getting a very high return on the cash backing options, it actually drives that upside downside capture, and it drives that compounding we talked about. But it's not 100%, right? So in a strong market, we can tend to underperform. Certainly in a strong market driven by where growth shares are driving that.
So you call yourself a value investor. What do you mean by that? What distinguishes you from a growth investor?
Yeah, we don't apply. We won't buy a share that has to justify a high and sustainable growth rate to justify its current valuation. So when we look at equities, we look at their current earnings, and we look at the sustainable level of their earnings and the cash flow that generates. And we then we obviously then assess the sustainability of that, the sustainability of the margins, and we look at that as in how we value the company. We don't say they're earning X dollars, and if they can grow 10 or 15 or 20% a year for 5 years, this kind of back, it's still cheap. We don't do that. So we don't pay for high growth rates.
Right. Okay. Take us through some of your top holdings. I notice your top holding is Prudential.
And that's one of them. Yep.
So tell us why you bought that.
Yep. So Prudential is the largest life insurance company in the US. It's also a $1 trillion asset management company. Now, we like the business of life insurance, or insurance in generally. That is a company that historically has traded around about 1x book value, and book value tends to be one of the more appropriate ways of valuing, high financial asset type businesses like insurance and even banks. So this is a business that trades at around 1x book value. Historically, the share price has dropped to around 60 cents in the dollar, 60 cents of book value, because financials are just not the sector that the market likes. But Prudential is a AA rated company. They haven't cut their dividend, as opposed to most other financial services companies or banks and so on have cut the dividends. They have not. So they are generating a dividend of around 8% a year. Their PE, if you want to look at that, is around 6 times. So this is a company that is doing absolutely fine in the current environment, is not overly impacted by COVID and related risks around that. Yet you can buy that at 60 cents in the dollar and get around an 8% dividend yield. Now that's a share that if it just goes back to book value again, which is about $100 a share, so it's trading at around 60. That alone is about a 50% return, and these are some of the advantages you have when you're a value investor, and environments like this show up. So that's why we like that company. Other holdings that we have in the financial space, while we're touching that, is Swiss Re, which is a similar type. It's not a similar company, but it's in the same kind of sector. It's a reinsurance company. They're a AAA rated company. Also haven't cut their dividend. They have a 9% dividend, which they just paid. They're also trading at around 65 to 70 cents in the dollar, and historically traded around 100, 110 cents in the dollar. So that's another example of an opportunity we have at the moment. And some other examples we have. One of the larger global brewers, Japan-based Asahi Breweries. They're the one that just bought Cotton and United in Australia just a few weeks ago. Because it's in Japan, and Japan is a market that equity investors have tended to disregard of late, or quite some time actually. We're buying that on 10, 11 times earnings, where their peers trade at generally 15 to 20 times. And so that's, those are just some.
What are the stocks you're waiting to buy because you've got put options out on them?
Yeah, so we've got some put options on, for instance, Lafarge Holcim, as an example, that is one of the larger cement, concrete type businesses, Swiss-based, but very globally diversified. That is a industry, which is basically fixed asset intensive, would benefit from non-residential construction and so on. That is trading at what we think is very attractive valuations with a very strong balance sheet. That one is undervalued in and of itself, but will also benefit in any recovery, certainly led by fiscal expansion, which we think is happening around the world, which will ultimately lead to greater spending on infrastructure and things like that. But in and of itself, on the current earnings, that is a very attractive price. And another company, Sodexo, as an example, they are a French-based catering and voucher and event management business. They have obviously been impacted by work from home and a lot of other things that are happening at the moment. But that's a company that used to trade around 100 euros. It's trading around 60 because of these issues, but we don't see them as being long-term sustainable problems. And we see the current environment is one where we can pick up those shares at an attractive price. Now, interestingly, because the volatility is high, on Sodexo, which is trading at around 62 euros, we're agreeing to buy it at 54. So quite a substantial discount, and we're getting paid approximately 20% annualized return on that. So it just gives you some idea of the.
But you might not end up buying it if the stock.
We might not, but we're happy to get paid a 20% return by just agreeing to buy it.
I see.
Yeah, yes. And that's the thing. The opportunity cost isn't much when you're getting 20%.
Yeah. You've got, just looking at your top 10 holdings, you're investing in many markets, US, UK, Germany, Switzerland, Japan, France. Your universe is so big. How do you filter them? How do you come up with the smaller universe from which to choose? What are your filters?
Yeah, so we use we obviously, like many other funds, we use a screen, which we try to filter what's several thousand companies down to, basically a couple of hundred. We look at a different range of factors that cover governance, which is how companies spend their money and allocate capital, profitability, which is things like return on capital, return on equity, and valuation. And that would obviously be whether it's enterprise yields and to EBIT or earnings. So we look at three different broad spectrums, which leads to 7 discrete filters, and we look to generate the idea generation is those that rank within the top 10%. Now we are geographically and sector neutral, so that means at every month, just say we're looking at auto companies in Japan. Just say auto companies in Japan, the top 10% will show up there. Media companies in the UK, the top 10% will show up there. So it doesn't choose regions or sectors, it just chooses the top 10%. And that's where the analysts, and there's 6 of us on the analyst team, that's where we go down into focus more individually on those, on that far smaller list to look for opportunities.
What's your fee?
We charge 1.15%. No performance fee.
No performance fee, right. And is there a buy-sell spread as well?
Yes, there is. I think it's 0.2.
Yep. And do you have a minimum investment amount?
No, we have we can have, our client base is quite broad-based, institutional, wholesale, and retail. We can, I think, $5,000 we could take as a minimum.
Right, and only on a platform or directly?
Directly. You could buy it directly. You could, download the PDS on our website, or we're on the vast majority of platforms as well.
And what are your distributions, or what have they been, and how often do you pay them?
Yeah, we pay distributions quarterly, and that's underpinned by the income we generate. They've tended to be around 7 to 8% a year for the last 10 years. And that, in fact, we increased our distribution driven by the high levels of option premium we generate. We increased our last quarter distribution by about 13% because it was, the income we're generating is quite significant. And we're going to be paying our next, end of kind of financial year distribution next week or 2 weeks from now. And that's going to be very high as well.
How high?
Well, we will probably end up, and we haven't fully, got the final number, so I can't be specific, but, a number around 7.5% to 8%. That's the historical distribution rate on the annual basis, and that you should not expect that to be lower at the moment. And given how high income generation is happening at the moment, we feel very confident that the long-term sustainability of our income generation and the distribution is going to be well supported, which has obviously been very, very advantageous for a lot of our clients who have seen dividends cut and other sources of fixed income and yields compress elsewhere.
So you're saying it's sustainable because the income flows from your put option method of buying?
That's right. So and high, the volatility at the moment, we used to generate 6 to 7% of option premium a year. It's now running at around 10 to 12%. So the income generation, which underpins the distribution, is actually a lot higher now than it has been for the last 7 or 8 years, which certainly will help our future performance, but it will also underpin the distribution that we're able to make.
And is the distribution amount generally independent of what happens in the market? I mean, say the market corrects now by 20 or 30% for some reason because there's a second wave of COVID-19. Would you still be paying 7% plus distributions?
Yeah. There are obviously a few things that go into the distribution, but yes, the vast majority of it is impacted by the option premium we generate. Now, as it so happens, the more volatile the market, so if the market did drop 20%, as you said, it's likely volatility would actually go up, notwithstanding it's already quite high. In our higher volatile environment, we actually generate more income. So, yes, I think it's fair to say that there's a very, very high probability that our income generation and distribution will not be affected by the market activity.
Well, that's very interesting, Chad. Thank you very much.
No problem. Thanks, Alan.
That was Chad Padowitz, the Chief Investment Officer and founder of Talaria Asset Management.